Jack in the Facebook group, she asked the question, and I reckon, a lot of people might be thinking this, a lot might not be, but how do you know you are in a good financial position to invest in a second investment property? Today on the podcast, I've got John Pidgeon and Rach Kroon from This Is Property podcast. I don't know, I'll throw to both of you. How do we know?
Yeah, look, ladies first.
Well, I think you would know, in my personal opinion, if you have, I guess if you're in a position to do it. So if you've got both the equity and the income to buy another investment property, but also if you've got the mindset to, if you want to be buying another property, that's generally when you sit down and do the scenarios, maybe with your mortgage broker and your accountant of how that would look. And I think that gives you a little bit more knowledge to go, am I ready to do this? I think that would start the process, kick it off, to start to think about if you're ready. What do you think, John?
Yeah, look, Jack's floating the idea, and you're right, mindset, big one, is like, I'm ready. But financially, it's maybe a little bit of an unknown. So, yeah, I think what's your own life doing? Cash flow management. What am I saving? Have I got emergency buffers? All the rocks and the foundations that we talk about. But then what's my first investment property doing? What are the holding costs for that? Because I think, and without digressing too much, like we go down a capital growth strategy and borrow the maximum that the banks will allow us, and all of a sudden we've got two highly negatively geared properties and we're potentially left out to sea in the event if we haven't got our foundations in order. So, yeah, finance, cash flow in order as well as mindset. In my mind, you're good to go.
And that's why I like to see those scenarios done. So when you get those scenarios done of how it's actually going to look and what it's going to cost you, and let's say it was, let's just pick a figure, let's say it was $150 a week to hold that property. Let's have a look at that. Have you been saving $150 a week? Have you been putting that into your, home loan as additional repayments? Is that going to change your lifestyle? Because I think once you've got all those figures in front of you, it makes it a lot easier to have an informed conversation.
Yeah, and I think, to be honest, the fact that they're asking the question probably means they are in a good financial position to buy a second investment property. Because if you had your home, you had your first investment property, and you were living week on week, and you maybe had a personal loan or something else, and you just couldn't get on top, maybe you didn't have an emergency fund, well, the answer's probably no. But I like to run people through our Sound Financial House, and we always have to be looking at this stuff. So I would ask Jack, have you got a cash buffer? Have you got your insurances in place? Is your estate planning sorted? So all these things. But I think at the end of the day, you then need to, and this may be for John, there's a difference in financial position needed for $1 million investment property and a $600,000 investment property as well.
Absolutely there is. Like the difference, we did a scenario a couple of days ago, the difference is about $1,500 a month of holding costs.
The odds that you have to carry.
From a $500K purchase to $1 million purchase. Like, okay, you can have the million, but you're going to have to facilitate a higher holding cost for for that short term anyway.
Yeah, so when John says holding costs, that's literally what you have to cash flow.
Yes, when you've already taken into account your
rents received, interest payment.
Yeah, and all the running costs.
There's a difference.
There's a difference, yeah. And obviously there's variances of that, using equity as a deposit versus cash, principal and interest versus interest only, etc. But it's just, it doesn't always work out to be double when you double the price, but it's a starting point.
I reckon as well, when we talk about property, like I would say it's a big commitment to pull the trigger on your very first property, your first investment property, or your second or third investment property. So you don't want to casually walk into this. Like, it has to be thought about. And I would encourage Jack and anyone listening, even if you wanted to buy your first investment property, what is your life looking like right now, and is it what you want it to be in 2 or 3 years? And the question is, well, no, it's not, because I want to study again or retrain or do something, or we want to tweak the house or renovate the house. So I think we have to bring in those other lifestyle goals and factors in, because we don't want the quote-unquote financial blessing of being a property investor to turn into a horror story because, we bought that and then we now literally can't afford any type of luxuries in our life.
And just as you said that, we had a client a little while ago that was looking at buying their second investment property. And when asked the questions about what was coming up in the next few years, one of those things was upsizing their owner-occupied. Now, that sort of came out in the conversation.
Yeah.
Now, when we actually reverse engineered that and looked at upsizing their owner-occupied, if they bought this second investment property, well, they actually may not have been able to do that. So you don't want to do something here because you're ready if it's going to impact
Be at the expense of living your life.
something that you want to do in the next 2 to 3 years, because it's not a 1 year goal. Like, you're holding property, you want to be able to hold it for a period of time.
Yeah. So in summary, do you reckon between the three of us, we could do a quick 10-point checklist?
Yeah.
So I'm going to cheat and go first. At all times, we want to make sure there's no consumer debt. So we'll carve out the car loan because, that's another thing. We want to make sure you've got your life insurances, your income insurances in place. We want to make sure wills and estate planning is sorted. And, you can walk and chew gum at the same time. You can go, yeah, we're going to get this happening and, review our estate plan. We probably want to make sure that we've got our emergency fund. John, with our emergency fund, if I'm Glenn, I'm in personal finance cap on, we might say, look, you really want 3 months worth of expenses as a cash buffer in your life. With your property clients, do you ever say you want an additional cash buffer per property, or do you just assume that a 3 months general emergency fund?
Yeah, so first of all, distinguishing that the 3 months emergency fund is for your personal life, not your property portfolio.
Yeah, okay.
The second part is, like the example before, the $1,500 per month versus $3,000 per month holding costs. I've got to allow for that right now in either my future earnings or in my savings buffer for my property. Let's call it a property buffer, or in some way, shape or form equity, right? We might draw down on some of that. So we've got to have that for the next 12 months. We've got to forecast and say, right, this property is going to cost me $20,000 to hold for the year. I can't wake up in 3 months and say, oh, all my money's gone. I've got nothing to hold the property for, because the bank's going to come screaming. So, yeah, the 3 month doesn't apply in property. It's got to be, what's it costing me before tax, before I do my tax return. That's why it's so important to understand that before I buy the property.
Yeah.
So there could be an extra $5,000 extra cash buffer for that property.
Or I'm factoring into my next paycheck to say I'm going to carve off $600 of my next paycheck and every other paycheck after that for this particular property.
Right, okay.
Yeah.
Rach, anything you want to add in terms of this checklist that we got side
Yeah,
railed on?
so I would say whatever that cost to hold of the property is going to be, and you might have done some figures on this. If you haven't, maybe even well in advance, sit down with your broker and work out those numbers before you consider it further. But whatever it is, let's see if on top of your buffer you can put that amount comfortably into your, your offset account over the next period of time to see how that feels for you. Like, go without those funds first and see if it's comfortable. It's a lot easier to go after 4 months, you know what, that actually wasn't comfortable for us, rather than buy a property and then have to sell it.
Just on that, Rach, and in maybe defence of the broker and or a buyer's agent, is sometimes the mortgage broker might not know what the running costs of a property are. Like, they'll know, okay, there's rates and insurance and whatever else, and the interest rate, and these are the loan repayments. But until we get down and dirty with the actual strategy in terms of location and type of property, we don't know what the actual rent's going to be.
Yeah.
So it's not until not the 11th hour, but before we start the search, we need to know the answer. But when you're having the initial chats with the broker, you might not know what the exact will be. So there's a bit of give and take on that one.
I think as well, you really want to make sure in terms of your financial position before you pull the trigger that you've got the ownership structure sorted. So have a look at last year's tax return, have a look what this year's going to be. If there's a spouse or partner, is it going to be 80-20? Is it going to be 50-50? Is it going to be 100 in either name as well? So we'll do tax structure. We want to make sure that there's no other big lifestyle rocks.
what are your goals, short and long term, and really sit down and work that out to make sure that this isn't going to impact them.
And this is where it gets to the point where it's like, do whatever you want with your money. But if you were in this position where you had your house and your first investment property and you always wanted to go to Europe for 3 months and it could cost 30 grand and you had that 30 grand, I'm probably doing that first. Because you'll be fine. You've got an investment property you set up, you're good at saving. So, I just think you will know if you're in a good financial position. And one hard line to say you're not is if you go to a broker and they say, we can't get you any money.
Yeah.
That's probably a
That's a
telltale
flag.
sign. Mindset's obviously a part of that as well.
Yeah.
Getting your head around it. Are you, not everyone that listens to the podcast, surprisingly enough, Rachel, is into property, which is strange, but in any case, we'll run with that. The other part of this question for Jack is not only do we know we're in a good financial position for an investment property, but some of us are in a great position but also don't realise it. So some of us go searching for, can we borrow money? I want to buy another property, the property nerds. But there's a whole heap out there that don't realise that they're sitting on a gold mine.
Yeah, 100%. Okay, here is one for John. It's a longer question, but I'm going to read it out and do my best. It's about a property in Perth. Now, if you are listening to this episode the day it drops on 13th of May, so Tuesday the 13th of May, or Wednesday the 14th, or Thursday the 15th, there are chances, potentially, that our live recording in Perth on the 15th, there could be some tickets left. Maybe not. We'll put the link in the show note anyway.
We could be live right now.
John's doing a property night the night before on Wednesday the 14th. We'll put a link in the comments for that. But anyway, it just reminded me because this is a story about a property in Perth. Okay. Would love some clarity / advice on a decision, please. My partner owns a 2x2 investment property in Perth. Is that 2-bed, 2-bath?
It's interesting in WA. They call it a 3-bed, 2-bath will be a 3x2.
Okay.
That's just what they call it.
Am I safe to assume there's no car spot? Or it could be a house?
I don't know.
Yeah,
I
okay,
think,
whatever.
let's say it's abbreviated.
The property has been valued mid 500K, originally paid 445 brand new, and there's still about 235 owing on the loan. Due to this property being brought prior to our relationship, it's solely in my partner's name. The property has supported us in buying our first PPOR with equity and getting a split loan to buy a car. Gosh, don't take that as anything. We just don't love using equity out of investment properties to buy PPORs. Anyway, that's why we're keeping this anonymous. We have discussed our goals and things we would like to do prior to having children in the coming years, and are thinking that selling this investment property could really push us along faster. Okay, sell it then. Next question. We want to renovate our PPOR, travel more, pay for a wedding, and set up more before having kids. Very ambitious. I love it. Our main objective is to be more financially stable prior to going down to one income when I eventually go on mat leave. Reasons for selling: 1, loan is solely in my partner's name. 2, investment property has big strata repayment and rental income doesn't always outweigh monthly cost. Yeah, but I think we've got to look at after-tax wash-up of stuff like this anyway. 3, would free up money we currently allocate towards saving and loan repayments. 4, allows us to renovate, travel and pay for the wedding. 5, we would prefer to eventually reinvest in property again in both our names and not within strata. We were thinking of doing a clarity call with John Pidgeon, but not sure if this type of situation is what he services. Would love to know your thoughts, opinions, and our situation, if you have any. I've left out our important if I've left out any important info, let me know. So number 1, I think I basically said, have an hour with John on the phone and thrash it out. But
Next question.
yeah, but honestly, it's sell it and move on, isn't it? Surely. Talk to me, Johnny.
Yeah, so I think there's a lot of reasons for selling. I agree. I don't like the getting equity out to buy our PPOR and grab a car, etc. But look, it is what it is, and I think if we're coming into the years where we need cash in our life because we're going to start a family, we've got a wedding, we've got some things that we need to stay cash heavy for. So that's a big argument in selling a property. And I call it phase 2 of our investment journey. Is phase 1 might have been we both came to the party with a property, we bought our own home, and now we maybe sold down on the original 2 to get our home or have our mortgage lowered to then start phase 2 once we've got our PPR. And this is maybe what we're thinking here is we can get back into property, but let's maybe just get our debts in alignment first. And what that means is we're paying down some of that bad debt first, because we've used equity. We've basically borrowed 103, 104% of the purchase price. If we sold this property, we'd take about maybe 250 off the table based on our debt and potential value there. Not sure if it was an owner-occupier to begin with, so there may be some CGT concessions early on there that we could capture, so that may be a bonus as well. I would love to know the makeup of the property and how long we've had it. I mean, we say it's a 2x2, but how many's in the complex? We know there's strata, so we just look at the location itself and then make an assessment from there. But a lot of things are leaning towards selling from what we can see here.
I think it's okay to sell property. Like, it's all circumstantial, but I think when you have big flashpoints like this, when you've clearly got a plan, like this person hasn't written in and been like, we have an investment property, it's in my partner's name, should we sell it just to buy property in joint names? It's like, well, chill out, Turbo, for 10 minutes. But there's a lot going on. You know, how much equity in total? So if they walked away, we'll call it 550, we'll call it round numbers, 250 owing. There's 250.
As I said about 30 seconds ago.
Yeah, sorry, I was texting.
But you look at it, and I spoke to someone about this in a clarity call
actually,
yesterday.
my question would be, does that 235 include the borrowed money for the house?
Yeah, for our deposit plus the car loan. Yeah, that's right. But either way, we're paying down some debt, aren't we?
Yeah.
Whichever way you look at it. But I think as I said, I spoke to someone yesterday in Perth. Perth have had unprecedented 3-year growth, which hasn't ended quite yet, but it might not be far from it. So are we going to experience this again in the next 5 years? There's a good chance no. So based on that, would we have seen a 100K uplift? And again, I don't know the timeframes of holding it, but would we have seen that in a normal market? By the sounds of it, probably not. So it might be a good time to sell an asset that isn't a superior one.
Yeah, you make a good point, because I originally paid $445 brand new, and it's now only valued at $50K more. They've obviously
100, 500. Sorry, mid-fives. Yeah, mid-fives.
Oh, sorry. Yeah, sorry. I just saw the 500K.
They may have had it 2 years, 3 years, or 10 years. I don't know.
But the thing is, if they had it 10 years, that equity, I think what you're getting at, could have happened just in the last year.
That's right. And it probably has. So them getting equity out to buy that property, their PPR, might have actually served them well because of the growth of that asset. And that's probably what they were thinking at the time, the whole adage of never sell.
Well, but my question is, if you step back as well, if you sold all this, if you can clear that split from the PPOR's probably had a good run anyway.
And it would have, yeah. So that might have been their alternative and this is the thing with individuals, like when they come together, everyone comes from a different mindset, a different place, we might be coming together saying, oh, I don't want to sell mine, you sell yours, sort of thing. And like there's all these loggerheads who are like, well, let's not sell any of them. Let's just all get it together and we'll borrow debt and go get on with it. But yeah, now we're sitting at a stage where, hang on, we want to have kids, we want to have a wedding, we've got this car that's got a debt on it, which is not ideal. We want to renovate, we want to travel. Like all of this says cash. So where's it coming from if we're not saving it? The only option is to sell.
John, do you want to read that from Sam?
Sam says, hi everyone, my partner and I are looking to buy our first property as an investment. It's about $600,000 and our plan is to capitalise on the capital growth and either sell it after 3 to 5 years or borrow against the growth to buy something else. We're trying to decide whether to do P&I loan or interest only, P&I being principal and interest, and would love some advice on what's the best option for our situation. For context, P&I would be 3,539 per month and 6.09% interest rate. Interest only would be 3,040 per month and 6.24% interest. Rachel.
You guys can sort that out for Sam.
Yeah, look, it depends on your own goal, and sometimes people do pay. I'm guessing this is your first property. It is your first property as an investment. A lot of people do pay principal and interest if they've got one property and it's their first investment. However, if your goal is to build a portfolio, I think the most effective way to do it is to set that up as interest-only repayments, set up an offset account underneath that property, and plough as much money as you can into that. And the reason for that is you can have the ability to take that money out and use it again. Where you can't, once you've paid it off that investment property, you can no longer, let's say you're buying a property for, I don't know, 600,000, you're going to borrow 500,000. If you pay that 500,000 down to 400,000 over the next few years, which would be awesome, you can only ever have $400,000 tax deductible against that property moving forward. But if you put that $100,000 into an offset account, you'd only be paying interest on the $400,000 while that money is in offset, but you have the flexibility to take that 100 out and put it somewhere else. And that might be, you might be buying your own home down the track and you can take that 100 out and put it into your own home down the track. So I'm not saying everyone should only pay interest only. I'm just saying there is benefit to doing that if you are disciplined enough to put it in an offset account. John.
Pretty good summary, sister. Look, Sam, great position to be in. Partner and I just getting into first investment. Awesome. 3 to 5 years, we go and buy something else. I'm surmising that something else is going to be another investment.
Yep.
If it's our own home, different conversation. But if it's another investment, either way, I think I'm with you. Interest only, where we're saving. There's about $6,000 a year that we are saving by going interest only. $6,000 that we're putting aside into a savings account or wherever. Over 5 years, that's $30,000, if my math serves me correctly. $30,000 as a deposit on a next property. If our servicing's strong, 10% is $300,000. Potentially an extra $300,000 that we could buy using our $30,000 of cash that we've saved on this property.
Yeah.
Yeah.
Or if you're in a rent vesting situation, you're planning on buying maybe 2 or 3 investments and then buying your own OC, you may get the capital growth in this property to be able to fund the next one completely, and you can leave that money in offset the whole time until you get that owner occupied down the track, if equity and servicing serve you enough.
Yeah. I think generally speaking, rule of thumb for me personally has always been P&I on owner home, interest only on investment. I know we've rebutted back and forth over the journey, Glenn, but that's our thoughts.
Can I give you just one example of where I've recently where I said to somebody to not pay interest only on an investment property? So it was a client that came through and they were putting a 10% deposit down. So it was a 90% LVR and the interest only rate would have been 7%. And the P&I rate was going to be 6.2.
So why is such a discrepancy?
Big difference. At 90%, sometimes the risk for the bank, interest only is a little bit more. So what we did is we put it onto principal and interest, took the lower rate. They actually did a few cosmetic improvements. We had it revalued and then it was 80%, and then we flicked it to interest only at
Smart.
6.3%.
Okay, so is the risk the bank or the client? Like, why was the interest rate so high?
The risk is that the client at 90% interest only was deemed a higher risk to the bank.
But it's never like 0.7, 0.8%
It
difference.
was at 90%. In this particular circumstance, it was.
Yeah.
It was such a big difference of rate.
Yeah, I know, but when you say circumstance, is it that client's circumstance or is it bank's policy
It's just
at the
bank
time?
policy at 90% LVR. We're
Right.
going to whack you so much more if you want to pay interest
Yeah, so
only.
that's a
so there
different
are
story.
outliers to it. There's sometimes we do say principal and interest, but generally in this case,
Yeah.
I would personally lean towards interest only.
Yeah, like if we're talking $50 a month difference here, no brainer, go P&I. But
600K investment property that Sam's looking to buy. Where am I buying an investment property for 600K at the moment that's good quality in Australia?
you sound like some online forum. An open-ended question like that, you've got 1,000 different responses.
If I wanted to buy a freehold property for 600K,
Yeah, so
where am I going?
if it's a freehold, as in I've got my own land, Torrens title or green title in WA, it's got to be some regional location.
Yep.
Yeah, so it's generally not a capital city. Maybe Darwin, Hobart are probably the only two left.
Right. Because
and-
Darwin did nothing for a million years.
Yeah, and it's quite hot at the minute, Darwin,
Right.
like physically, and the property market is going well, but it has its speculation about it. So, yeah, why the question?
I'm going again, baby.
There's no regional New South Wales for 600?
Yeah, heaps.
Oh, okay.
Yeah. What did I say?
Oh, I
Yeah.
thought,
You said-
Regional.
Yeah.
Regional.
And then you
anywhere
said
around
maybe
the country,
Hobart,
and then capital
maybe.
city, we've got Hobart.
sorry, threw me
yeah,
with Darwin.
Yeah.
Yeah. No, I'm potentially might want to just pick up a little one like that.
Yeah, well, I'll send you a clarity call link and we'll
Yeah,
have a
let's
chat,
go.
right?
Let's go, baby.
But yeah, look, there's plenty of options out there. Like we see good real estate, dare I say it, 400 to 500K. Like people get this perception that, because it's $1 million in my city, that's all there is out there. Like there is, and when you're talking 10% interest only, like 10% deposit and then interest only loans, like you're in for 70 grand total costs. I guess we can get that done pretty quickly.
Yeah, so for me, you know how we did the years, money in your 20s, 30s, 40s, and then on retire, we did 50s, 60s, and 70s. If you want those on our YouTube, we've actually got a playlist called Money by Decades or something. But I was really, when we did the one for my decade, 30s,
Just.
no, when we did, like, I was personally challenged, and I'm like, what am I doing with my life? And because I guess I did have financial goals like building a studio and all that, and that's done now. So I'm thinking, what can I do for the years to come? And I do want to buy a property at some stage in or around Newcastle. And it might not be for 5 or 6 years. So what I'm thinking is, well, I need to turn everything up again, potentially go again, because when I do buy a PPOR, I'll be selling some type of assets to put into it.
Through fear of turning this into a clarity call, why wouldn't you buy something in Newcastle now?
And just put a tenant in there.
Yeah.
I haven't even thought about that. Giddy
No.
up, baby.
the
but
clock is ticking.
Yeah, it is very much ticking. Yeah,
and well, I was
especially
like,
in
I was
places
even
like
thinking,
Newcastle.
because I've got the little pockets where I want to live. Maybe I should have a clarity call with you.
Let's do
I'll
it.
pay you.
We'll do it live.
I'll
Can we
pay
do
you.
it
No,
live
I don't want your
Oh.
money.
Yeah, maybe. I just don't want everyone to know my personal financial situation.
Okay.
But I will say, in line with me using one car and not buying a new car, and over the last year of, I guess, being on the ADHD medication and being more aware of my proclivities to spend every living cent, I'm now a bit more measured and considered, and I'm not spending every living cent. Little things like, for the office here, the old Glen would have just went and bought a $4,000 Giotto coffee machine. You know, like the one at Maddie's office.
Yeah, they're good.
But I'm like, you know what? I don't need to spend that. A $600 Sunbeam.
Fine.
It's fine.
Aldi beans.
Aldi beans, they're okay. Vary it in milk. So I am being more measured and considered. So I'm actually moving, because you made that comment before about the P&I on it. I'm actually moving all my loans to IO at the moment.
Wow.
Because I'm
Going
going
to
because I'm going to go again and now get really strategic about my lifestyle goals, because I was rattled myself when we did those age episodes.
Yeah.
I'm like, what am I doing here? Got to stop flapping about. But relatively, I earn a good living and all that stuff. But relatively for me, I need to get more strategic. So that's why now that extra P&I that I was paying into those mortgages, I'm going to divert potentially into another property or something like that. Speaking of capitalist pigs, Ryan in the Facebook group, interested to hear from others what changed when they went from owning one to multiple residential investment properties for the purpose of optimizing and simplifying in terms of property management, changing ownership structures, insurances, ways to track expenses / earnings and performance. How do you guys manage your investment properties? What changed?
I was pretty pumped about having, and this is my little tip and not everyone loves it, but I have an offset account for every property and it's linked to my home loan. So it only ever works against, the debt that I want to get rid of. But all of the rent goes into that offset account and all the expenses go out. And I just love to track it. I love to track and I keep each buffer one in there, but every property has its own offset account named that. And I just find that a really simple tool to track each property.
Should have heaps of offset accounts, John.
That's right. Should be. No wonder CBA came out with unlimited offsets.
Yeah, that's right.
That's for Rach. It's called the Rach offset system.
Her mortgage broker was the one who won all the awards after writing all Rachel's loans.
Yeah. Wow, that's good.
But in all seriousness, so that's a good way just to quarantine and split.
Yeah, and you don't need to have it. There's people do spreadsheets or whatever, but I just love to go onto my internet banking and see it all there, and it's just my accountant also loves it.
Yeah.
Okay, that's good. It's a good tip.
How do you do it, John? And, if someone is going from one investment property to the second one, are there any other strategic things that they need to think about?
Well, I think it can be quite daunting in people's minds, like we said before about the first property, but and stretching ourselves. We're stretching ourselves in our own mind a lot of the time when we go to buy multiple properties. Like you think it's all going to compound, and a lot of it's based on our experience we've had with the first property. So if we've had a horror run with tenants or a bad property manager or whatever, like do we actually want to do this again? We're going to get the same results. It's like having a first child that's like annoying you. It's like, I don't want another child sort of thing. But it's not really like that. And I think the term I thought of when Ryan, when I saw this was excitement. It's like, okay, I'm building my portfolio, I'm building my wealth, I'm leveraging the bank's money more. In terms of property management, generally speaking, our property managers are going to be different. So you've got different property managers around the country wherever you've bought, so that you're managing those property managers to make sure that they're doing what they need to do. Ownership structures, I don't know. I think people overcomplicate things when it comes to ownership structure. But in term, you obviously seek some advice in that space with your accountant. Insurances is just... Yeah, there's a lot of insurers out there that'll give you multi-property discounts, so that's probably a bonus from that point of view. They do, and this is probably a logistics thing. Like if we spent more than 4 or 5 hours on our portfolio for the year, there's something wrong. Because you're outsourcing majority of it to your property manager. They're doing everything for you essentially, and you're having a conversation with your mortgage broker maybe once a year around finance structures, and then you're doing a analysis or performance of what your portfolio has done.
No, Glenn's going to Bunnings and getting handles.
Yeah. So if you're changing taps and doing everything yourself, then I suppose you're the minority.
What handles did I buy?
Remember you were saying in one of the episodes, you're saying
you should never have property close to you.
No, I shouldn't.
It needs
but
to be
also, the property manager at the time should employ handymen who aren't friggin' lazy
Yeah.
and can use Google
True.
and sort it out. And
Yeah.
I'm no longer with those managers because, yeah.
Comes back to having a good property manager
Yes.
who can,
Yeah.
like,
And I
obviously
mean,
get
all
you
my
quotes
properties
and-
are within an hour drive of here, and I use the one property manager.
Yeah.
But in terms of my
Yeah.
own personal cash flow system, for those who have done the Glen James spending plan, I have all rent from all properties go into the cash hub, and the mortgages from all the properties leave that same cash hub. So it's just income and expenses. I don't have the individual accounts. If something needs doing, I just take it from savings or an emergency fund or something like that. So I think my biggest thing would be get a good property manager who is onto it and who has attention to detail. And at the end of the year, I just log into my bank account, look at the interest for each of the loans, send that to the accountant. The property report, have a thing. Here's the income, expenses, details. Like each property has like a 2-pager for the accountant. It's really simple. And I probably would say with the what was I going to talk about? You're basically paying that's what I was going to say. If you do need to pay an expense for the property, get the property manager to pay for it, and their report will catch it for your reporting.
Yeah.
So I send
Everything.
all my rates to the property manager. I send the insurance to the property manager. They pay it. Everything goes through to the property manager because it's all about consolidated reporting.
Keep forgetting to send my insurance to the property manager. That's the one thing I haven't got
insurance
sorted.
and
Change the
interest.
address to the
Yeah.
property manager.
Well,
Did your
I
Terry share
preferred
this year? Mine went down 27% on 3 properties. Went down 27.
Yeah, mine went down as well.
That's good.
Mine did not.
I still prefer to
I was like, did they
my
do
own
that?
insurance, but-
Yeah, okay.
do you?
I organise my own. That's the only thing I do out of the management
and then you
statement.
just send them the statement.
Yeah.
But I run a property management tracker. You can put up to 5 properties in it, which doesn't cover your portfolio, Rach, but it gives you can fill it in monthly or quarterly, and it gives you a summary of your whole portfolio, which is cool. I can put it in the show notes if they want.
Yeah, we'll do
Yeah.
that. People can buy that.
And then no, we can give it away.
Oh, okay.
Yeah.
We'll do that.
Earnings and performance, we use a 20-year tracker to update yearly and just see how that's tracking and update your performance there. So, I think sometimes, Ryan, we overcomplicate it as investors in the property space.
Yeah. I don't like when he said, what do you do to track expenses and earnings and performance? It's like an annual thing. It's like, okay, here's the rent for the year. The expenses are pretty stable. Performance, I don't know, not selling anytime soon.
Ask your broker to send you a property report each year. So when they do their review, get the property report. That's how you sort of track its performance of what's this property worth right now.
Yeah. I bought one through John, and he sends a report every year. Don't know if he would send the report if it went down in value, but
What'd you buy?
Newey, where did that? You were the person who introduced. It's on your system.
Right.
I got one through John and I sent him the report. Be like,
Oh,
look
the
at this.
totality report.
Yeah,
Yeah.
whatever it is.
Yeah, okay. Yeah. So, I'm confused here. But in any case, the tracking is great, but don't overcomplicate it. And I was going to say something on this in terms of, every year I think the neglected part of it is maybe your repairs and maintenance. So to say, well, okay, property manager, what may I need to attend to in the coming years, and just forecast an amount for that? Because I have the account set up separately, so the loan is tied to the home or the investment, and then my account's linked to that. They're not combined like you have yours, Rach, which is there's no right or wrong, but
Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.